This is the Future of Finance.
This episode has been brought to you by Metis Global Partners. Hi, everyone. Welcome to the Future of Finance podcast. I'm George Dyer, and today I'm joined by Chat Reynders, Chairman and CEO of Reynders McVeigh. We have a great conversation about how investors that truly take a long-term view and use sustainability as a lens can drive strong financial performance, both by avoiding big losses during market dislocations and by helping to identify those companies that are positioned for the future economy earlier than others. Chat talks about his career experience making documentary films for the first IMAX theaters and how that has informed his longtime investment career, as well as the complementary styles that he and his co-founder, Patrick McVeigh, bring to their work. We also talk about what they look for when they're hiring and why they're starting to be more vocal about their longtime commitment to sustainable investing during this time when many others are going quiet. What really stood out for me in this conversation is that it's just a great example of how being really smart and thoughtful and deliberate about incorporating ESG factors into a strong fundamental investment process can be like a superpower. And we talk about how different that is from what many people think of when they hear the term ESG investing these days, which is often more of the surface level uses of ESG data that have given the field kind of a bad name in certain circles. So Chad is a really dynamic and fun guy to talk to. His passion and enthusiasm for this work is really contagious. And so I hope you enjoy the conversation as much as I did. A reminder to please follow the show, subscribe to our YouTube channel, and let us know what you think in the comments. And now here's my conversation with Chad. Hey, Chad, how you doing?
George, I'm great. Great to be with you today.
Great to see you. Thanks so much for doing this and joining the podcast.
Oh, it's going to be fun. I'm very excited. Very excited.
Me too. Well, I'm so excited to talk about your work and all the stuff you guys do at Reynders McVeigh. But would love to start. I actually didn't really realize that you came from the documentary film world. So tell us about that. How did that happen?
Well, sometimes necessity is the mother of invention. When I was leaving college, it was the time when Drexel Burnham Lambert was blowing up. Insider trading was all over Wall Street. You know, Michael Lewis was writing Barbarians at the Gate. So Wall Street wasn't a particularly fine place to be. I'd grown up, my father was a broker, and so I'd grown up kind of in the shadow of Wall Street. And I was doing my internships in the summer. But then when it came time to graduate, there were no jobs in finance. Literally half of New York, half of the firms had blown up, and it was kind of like a mini financial crisis. But that's what I came out into. And frankly, I wasn't particularly enamored with what was going on Wall Street. And I had my own view of what should happen with what you do with capital. So, of course, I did what any rational young man who looked about 12 years old at the time would do. I created and put together a model for an IMAX film on whales. So natural step.
Of course. Yeah. That's so cool. So it was a documentary, and that just sort of how long were you in that world?
Yeah. So it was, at that time, IMAX had just started. So it was just a very early nascent, there were 40 theaters around the world, but they were all in leading cultural centers. So it was the Boston Museum of Science here in Austin. I remember that one. Children's Museum, Smithsonian in Washington, as many people went and saw To Fly in that theater many years. But I was excited about that because what was happening is these theaters were being built at these cultural institutions, and Boston Museum of Science, had 400,000 people that were visiting them. And once the theater was in for 4 years, they had closer to 800,000 people visiting. So it was a big change for these organizations. And my hope was to figure out how to direct capital toward a very strong project that might draw those audiences to the theaters. And 80% of the money in these IMAX theaters went back to the cultural institution, very different than what goes on in Hollywood. So for me, that was very early in my life. I said, well, if I could just design a model that could draw together capital to put together this product, it could be fuel for driving growth and improved financials for these leaving cultural institutions. So that was my idea.
The driver.
Did I know it was going to take 4 years and that I was going to have to teach second grade for 3 of those years? So I got free housing. Did I know I was going to be living in a barn above the largest collection of humpback whale songs in the world for a year and a half, running a nonprofit for a MacArthur Fellow. No. But was it an amazing adventure? Was it hard? Yes. Was it an amazing adventure? Yes. But we got it done. We raised $5 million, put out one of the top IMAX films of the year, and created a model that invited foundations, individual investors, the distributors that were already in the industry, to all stand together shoulder to shoulder with an impact model that said, we're going to respect capital first, and we're going to be sure we're getting this money back to people first in design. And then we're going to respect the institutions and how this money needs to flow to the institutions. And then we're going to look toward our profits. And at that time, that was anathema to many people. But the people that connected got very excited about the idea of solving all of those goals with one project. And so I was very pleased about that. And it turned into a model. I ended up getting hired by a financial firm. And then we did on the very same model. And I'm a big believer in replicable models. You build a fantastic model that works, and then you figure out ways to replicate it. And then you figure out how to get other people to replicate it so that you really create an impact. And that was the first example of a replicable model that I had built, where we built 6 other IMAX films. One of them got an Academy Award nomination. 2 of them are still in the top 10 of all IMAX films of all time. So I'm proud of it. It was a tough start, and it beaten up a lot, but I'm proud of it.
I'm sure. What a cool start to the career. So how did you kind of make the jump back to Wall Street then after?
So I wasn't a fan of Wall Street per se, but I was hooked on the idea that if you can direct capital toward good purpose and you can create a structure, a financial structure that promises, certain return, and really respects the capital, that you can do a lot. And there was a firm, one of the individual investment firms that had given us money, did a lot of work here in Boston with literally law firms, right? And individual families and multi-generational family architectures. And my job was to come in and learn the goals and the aspirations of these different families, to understand how to be a trustee, how to serve them well in the public markets, and really getting my real education and on the ground investing in public markets. But I was also bringing the private market and impact piece, and they asked me to apply that in other areas. Could I do, sustainable timber? What do you think about solar? How would you do this? And that was a really enticing opportunity for me, because there was capital there, and also the opportunity to continue this effort on impact investing, which to me was very exciting.
Yeah, amazing. And so how did that lead to the founding of Reynders McVeigh?
Well, Patrick McVeigh, has been a leader in sustainable investing for a long, long time, and he started very, very long ago. So while I was doing my IMAX films, he was in California, totally different background, working on food co-ops and building models for how to get food to communities in a more effective way. So he and I are very, very similar in our mission-based thinking. And he and I both, when we talk to each other about this stuff, cannot stop talking about it. And we have this cross-pollination. So we think differently, but we're trying for the same result. So we hired him at that very same firm that brought me in. We hired him in to direct research for us. And he had come to Boston years ago. He was the precursor of Trillium, right? Franklin Resources. He was the first employee at Franklin Resources, and he was the first researcher there. So he's got a long route. And what's fascinating to me is when you're trying to solve problems, it's really different types of thinking that you have to collide together to create real solutions. And Patrick has the ability to see opportunities where other people aren't looking. And I tend to have the opportunity to distill very large, longer term opportunities, right, into a specific zone. So when the two of us meet on an idea, it works pretty well. We've had a long history of it. And so we have so much fun doing this work because we both love it so much. So.
That's great. So was that, you're working together and he said, we've got this chemistry, we've got this sort of complementarity that I start a firm?
We were working for, there's such an opportunity, George, in impact investing. We don't see it as a secondary. We just think this is the path to real growth. And this is, if you're compounding returns over a long period of time and you're not thinking about sustainability, well, then you don't understand what compounding is, and you don't understand the risks you're taking to that compounding. So our firm that we were in wasn't as geared on that. They were geared on the idea of, at the time, kind of holding on to what they had, and we were much younger than the management, and we just felt we had an opportunity that we wanted to go after, and so we did, and it was it was scary, very scary, but I will say some of the first supporters of what we did, which will surprise listeners, I would guess, were those law firms who said, we trust this discipline. We see that you're seeing liabilities that other people aren't seeing, and we think this is maybe a higher fiduciary standard than we've seen. And remember, the law firms in Boston, they're the ones that got all this family money when the whalers would go off. It was all designed so the law firms could do this. In New York, it was the banks, but in Boston, the law firms. But these law firms have the courts looking over their shoulders, right? These law firms, they have to be investing in very, very high quality assets. And so it always surprises people when we talk about the fact that those were the people that first came to us and said, this discipline makes a lot of sense. So sustainability and fiduciary management actually sit pretty tightly together. And a lot of people don't see that.
Yeah, we certainly see it. But this is 2005, right, that you're getting this going?
Yeah, it was a little earlier than people were ready, perhaps, but we were researchers, right? We do all of our own research. We do all of our research in-house. We are clear-minded about what we're doing. And, Patrick will tell you, when we first started this, he brought a book to me, Security Analysis from Graham and Dodd, and he took me, I think it was chapter 7, and I may be wrong, it could have been 8, but he reads it to me and he says, look, like Graham and Dodd, like the anchor of what all the stats and data we use to quantify, to find quantifiable results, that's what we trust is Graham and Dodd. And in this chapter, what they say is there are two things that are critically important to a company. One are the objective quantitative factors that you can measure and see, and things like price to earnings ratios, things like all the things we talk about on Wall Street. We do all that work. We are very focused on the idea that quantitative work is important. But the other thing in that chapter that they said was 50% of it was understanding the subjective factors that impact management and the choices that they make. And what they wrote in the chapter was, that's really hard. So we're not going to do that in this book. We're going to focus on the quantitative. So everybody's focused on the quantitative, but Patrick came to me and was like, this is really interesting. And if we can find ways to measure out where there are liabilities that other people aren't seeing, we're going to have a better chance probably at sustainable returns, because we're going to avoid, and what we talk about are asymmetric liabilities. Like you're not going to avoid all liabilities at every turn. That's just not reality. But there are asymmetric liabilities out there that exist that people don't kind of pay attention to, or they don't pay attention to them until they hit a turning point when the liabilities are actualized. And then people say, oh, I should have done something. So for us, we've always had this fiduciary sense, this idea that what we do is anchored in Graham and Dodd, but it is additive. And what it requires is a real research process, which is, I think, some of the mistakes that have gone on Wall Street in the last 20 years.
Right. Yeah, well, I want to jump into that, but talk a little bit more about asymmetric liabilities. What do you mean by that?
Well, I think sometimes people don't recognize liabilities that can dislocate you. So for instance, or what happens in a dislocation. So for instance, for us, as just an example, we tend not to be heavily weighted in money center banks or financials that have significant counterparty failures. That's different than other sustainability shops or different than ESG shops, because that's often where people go and say, oh, well, they're the ones that give money to people to buy houses. It creates the American dream. It does all this stuff.
There's not much carbon emissions or whatever.
We see it as you've got to be really careful in environments. Usually when there's a dislocation, it has to do with too much leverage in the system. At least over the last 5 major problems that has been there. And oftentimes when you have assets that don't have cash flow to support them, so commoditized assets, those really don't do well in dislocations. And so for us, in the design of what we're doing, we will tend not to own some of those things that when you get an asymmetric turndown, like a dislocation, they simply don't have the support to be able to manage that, and they tend to get damaged more often. And then you can talk about asymmetric risks. We can talk in this exchange about, climate change, and we can talk about how policies are being torn apart in governments, and how convenient that is to be able to not have these policies, and how the companies we talk to aren't changing what they're doing with climate change because they see a real potential risk. They are saying, look, I don't want to be a carbon emitter because I'm worried there will be liability eventually because there are real risks that come with this. And so that's an asymmetric risk. When you're looking at the market today, I mean, for goodness sake, the market is turned upside down. The indices that are supposed to be the diversifiers that allow you to make an investment and diversify away some risk, they're now the concentrated thing.
Super concentrated, yeah.
And so we're upside down. So that to me is an asymmetric risk that we have to pay attention to. We've not been in that structure before. So how do you get brave about leaning against, an AI trade that could go for 3 more years? I don't know whether it's 3 months or 3 years, but this infrastructure AI, if you haven't been there in the last 3 years, you've underperformed massively. Now, we've been there, but we're trimming out of that and buying into other areas of the market. We're being disciplined about it and telling clients that sometimes chasing index performance doesn't make sense, much like the late 90s when, the only way you were going to keep up with the index in 1998 and 1999 was to buy more of, and Cisco back then was trading at like 90 times earnings. It's not, it was way more expensive then to do it. So we tend to look at those things and our clients, we rely on our clients' trust in us and our discipline. They're in this game to say, we're with you for a very long term, right?
Right.
People that are trying to win the year or win the quarter are, they're the ones that get really beaten up in downturns and in shifts of regimes, which we see happening, So I look at it and say, for us, we're really focused on the idea of long-term and long-term clients. We're really focused on the idea of compounding returns. And in order to compound returns, Charlie Munger's quote about compounding returns, what's the number one rule? Don't interrupt compounding, right? And so instead of being tactical and shifting around these pieces, we tend to move organically over time.
Yep. That's great. And I think it's just a great articulation of another form of like small S sustainable investing. Just how do you maintain over the long term? And one of the big things that always comes up in these conversations is around financial performance. And there's this kind of super persistent myth that, sustainable investing or aligning investments with mission or values is going to require you to sacrifice returns. And that has not been the case with you all. So talk a little bit about the performance.
No, that's not the experience that Patrick and I have had. And, everybody can parse out, our balanced moderate composite since its inception has outperformed the MSCI World to date, in these last, to date, by more, when you average it all out, by more than 1% a year. Now, there'll be some years where we outperform and some years when we underperform, but the character of our performance reflects what it is we're doing. A lot of our outperformance comes from not catching all of the downside in big turns, right? And recovering more quickly. So that would be, when you have the 2008 going into 2009, we started our company at a pretty rough time. If you think about it, we started in 2005. We had the financial crisis, right? We had the pandemic, we've been fighting some battles. Yeah. But the truth is that the portfolio has done what we hoped it might. I wish it hadn't gone down at all, of course, but it's going to move. It's going to move somewhat with equities. But that resilience is a hallmark of kind of what it is we're doing. And when clients see that, they get some trust in it. So the nature of our outperformance also reflects what it is we're trying to do in the portfolio. And so when in the portfolio, again, we look for really long-term themes. And then we look to compound within those themes. So the strength of our thematics, right, make a difference on the upside. And the care we take with our selection, whether it's an individual balance sheet on a company or whether it's staying away from lending organizations, whatever it may be, those are the things that help guard the downside. So, today people might say, oh, well, gee whiz, you're not going to do well when oil does well over like a 3-year period, right? Because you don't own fossil fuels. And we haven't owned fossil fuels for a while now, as you know. But a lot of that has to do with the fact that, A, there's too much liability there. And when the liability hits, where nobody knows how bad it's going to be, but it doesn't seem good. And we'd rather be in businesses where there's a clear run and better growth. Remember, Patrick made this point. Patrick wrote about the idea that we were at peak oil demand, right, back in 2009, saying like, we're already at peak demand because the alternatives are coming up. Efficiency is changing the world. So for us, looking at something like energy, looking at something like saying, like, we would rather invest in robotics, automation. I mean, that's what our cyclical budget is for. And so when people think about it, they think, well, if you're missing something from the S&P 500, you must be missing something. And it's like, no. Right. We're avoiding bad industries and we're investing in good industries where we have more transparency and there's less liability. And so we're simple-minded people, but that makes a lot of sense to us.
That's what I've always, just loved about the concept. And I think it gets lost so much in the conversations around ESG investing and the like, is that, and it takes that long-term perspective. Like we know we're heading this direction generally. And as you say, if you're a great investor and you can see where markets are going, you can protect some downside risk along the way. But you have that sense of direction, right? That we're transitioning away from fossil fuels. We're going to clean energy. We're going to automation. Tech is, continuing to change the economy, all these things. And you might not be able to pick and choose, within the quarter of the year. But if you have that decades long perspective, you can have a little sense of direction.
You can see it. You can see these big cogs moving. Right? A lot of people, sometimes there are little cogs that do amazing things, but it's the big cogs of change that you can kind of see and move forward and trust. And as innovation hits it and accelerates it, that's what people should be really focused on. And instead people get focused, the short-termism of our, the media that pushes everything on Wall Street. Every time I turn the television on and read it, something's either cratering or soaring, right, or emergency breaking news.
Urgent. Yep.
Everyone just is on their heels. And so we try to take people back to the more academic focus. And, and that's a good example. ESG is a great example of a problematic approach on Wall Street where, look, all ESG are data sets, right? The data sets are improving, but they're still backward looking. They're still imperfect. They don't really draw in all of the information, but there is, they give you a signal. They give you some breadcrumbs that help in a research process to look and see what you want to approach and attack. Wall Street turned that into, an ESG institution at, name your place, all these ESG products, everything getting productized. I remember getting a call. I won't mention the place, but they said, you guys are great researchers. You know what you're doing. Can you build us a small cap, a mid cap, and we need a Europe and and can you do it in 3 weeks? And I was like, it's not what we do. And I understand you're trying to feed the engine, but that's not okay. So a lot of people got caught up with ESG and Wall Street was using it as a shortcut. They were saying these imperfect backward looking data sets, they're like, oh, that's research.
Yeah.
To a research shop like us, we're like, that's research? Like, that's just data. Like, you have to do the work. And nobody was doing the work. And everybody was trying to create the stories around it and sprinkle a little ESG dust to create changes. And also, I will say, just so your listeners know how terrible it was, I mean, sometimes these indices would get branded then as ESG indices. And in many cases, they held 97% of what they held before. And they might own some stuff that anybody that was in sustainability would be like, why do I own this in an ESG portfolio? And so people were just being fooled. I mean, they were being marketed hard and fooled, and very frustrating because it only reinforced some false sense. That's why we're stepping forward a little bit right now, because we feel a little bit as though it's really important for people to understand, particularly endowments, foundations, families, really important. Oh, people that are looking for sustainability to bring it. If you're somebody that's trying to find a good discipline in this area, boy, you scratch the surface. There are people that do really good work, but that Wall Street kind of blocked that off.
Yeah, absolutely. I mean, we saw like just distilling it all down to scores and just kind of mindlessly using that to put portfolios together. And it's the terminology is so tricky because that's, in my view, what it was never intended to be. As you said, it's better data. And then you get the flip side. People will say, well, like, if it's just data, it's just fundamental research. Like, why do we have to give it a name? And I think on some level, you don't have to. Like, these are material factors that good investors have always looked at. If there's a social or environmental factor that's going to affect the value of a company, a good investor is going to look at that. But I think some of these issues are so big, systemic, new to the 21st century that I think that some ESG frameworks just help make those more explicit and help investors maybe like look at those issues more systematically than they might otherwise. And that's what I think the value of ESG is. And then you still need to be a great investor, like you guys clearly are, to take that data and make good decisions and do your thing.
Well, I think you also have to have perspective. Wall Street really is trying to win quarter by quarter. Mm-hmm. So their job was to get as much product out as possible, using this, and to have it built as quickly as possible, and also scale, right? Everything is about scale now. Private equity is buying up independent people, pushing them into, this whole investment world is becoming all scale focused. And to me, what that does is and think about it. How many people actually talk about individual companies anymore? Everything is about an ETF exposure. Everything's about a product that gets you a product that gets you to where you want to be, and people are getting further and further away from their investments. And then you add this idea of scale in the industry, where they're serving more and more people as best they can, and kind of lowest common denominator work comes through. Something like ESG really works in that environment because a bunch of people make money, like they sell it and then they get their bonus in that year, and then they're just figuring out like what the next thing is to sell next year. You really have to have a long-term view, and you have to have adaptability. You George, that was a really good point you made about the idea that like the world is changing a little more rapidly than people think. And if you have a research process, you can kind of analyze how those changes are happening and where capital is flowing and why. And you can understand how companies are managing some of those risks in the context of a longer term opportunity. Yeah. And that allows you to build and grow within that theme. That doesn't happen on Wall Street as much now. And it's really about chasing to the momentum or about creating products when something seems like it might be popular or interesting. So I just think listeners, a lot of your people you work with are very long-term investors, right? They are thinking in terms of that scale, and that's also that's an important thing for anybody else listening to this podcast to understand is, if you were asking me, the great advantage in long-term investing is this compound returns, and a long-term perspective gives you the ability to invest to compound. And if you don't have that, it's a lot harder to succeed over long periods of time.
This episode is made possible by Metis Global Partners, a global equity solutions provider managing over $5 billion. Metis offers both active and customized beta strategies for institutional investors. Through their guided beta product suite, Metis provides custom passive equity solutions to clients desiring sustainably aligned equity and real asset portfolios combined with a high-touch partnership. Founded in 2013 in San Diego, California, Metis serves a wide range of institutional clients, including foundations, endowments, nonprofit, university, public plan, corporate, and family office clients. To learn more, visit www.metisgp.com. That's METISGP.com. Or email info@metisgp.com. Yeah, well, I was going to ask when you were talking about just how sort of fast everything is, and there's this push to kind of short-termism. How do you all have like a discipline or a way of helping yourself step back and not get sucked into that? Because I imagine it must be tough when you're going to the office every day. And
Well, we're excited. I mean, don't get me wrong. I mean, we get all fired up about all sorts of companies all the time, every day. But we do have a process where we create our focus list of stocks every Monday morning. We all sit at the big table and we talk about what's on our focus list, what are the new ideas that are coming in, why are these new ideas interesting? You know, AI is fascinating right now because you have, people are learning a little bit more about sort of when you move from the infrastructure build out, what does that begin to turn into and why? As this infrastructure build out changes, when there are different chip technologies, what does that mean? How changeable is this whole universe? So we can't be like massively confident about what's going to happen, but we need to be discussing as researchers what we're seeing and why, and drawing in a lot of capable talent to talk through all of this. And so we spend a lot of time getting really excited and jacked about potential themes.
Mhm.
And we understand what's happening in the market, and our job is to kind of sort out what the market is trying to say and sort, because obviously our clients every day are watching that television and seeing breaking news and
Right.
emergencies and all this stuff.
Mhm.
So for us, we just keep the long-term perspective because we know that's where our advantage is. And we know that's where your investment advantage is. And so for an investment to get to our focus list on a Monday, it'd have to be introduced, right? We'd have to talk about all the research together for multiple days. We would have to look at our focus list and say, this company we believe has the ability to compound over the next 10 years in a profound way, in a better way than maybe some of these other companies we're investing in. And sometimes, don't get me wrong, sometimes, I mean, that's the core of our portfolio, but we're also about innovation. So some of what we invest in smaller pieces might be earlier stage companies. When we bought NVIDIA in 2016, we didn't buy NVIDIA because we were like, wow, AI is going to be amazing. We bought NVIDIA because their processing was so much more powerful, and we were seeing this sort of parallel processing capabilities that were coming out of NVIDIA and saying, well, processing is going to be a major feature in the future. And so a lead processor is somebody we want to have in the portfolio, and we want to see the innovation happening. And so that was it was like a little seed, and it wasn't, and NVIDIA was doing fine, but it wasn't doing anything incredible. So we
Yeah.
tend to plant some of those seeds as well early, and so our research is constantly looking for those too.
Yeah. Well, you talk about looking at companies that are positioned for the future economy, which I think that is a clear, great example of, because a lot of, sustainable investing is about like negative screening, like just not holding companies that don't belong in that sustainable future, or leaning into those that are driving the solutions. But how do you think about like position for a future economy? Because, not every company is going to be a sustainability solution, but it's got to fit in a sustainable future, I would think, right?
Yeah, well, it's hard. It's hard. Some of it is how close are you on the sustainability side. So one thing I would, to what makes it sustainable, what makes our economy sustainable. So for us, for instance, on closer to that end, something like water infrastructure, right? Climate change creates change in where water is, how it's sourced, and what happens. And the water demands are only going up all around the world. Now, I can't buy, it's really difficult to buy water resources. It's really difficult to buy different technologies. But what we're finding is that technologies in water treatment, technologies in water movement, and water transport are going to be critical central cogs, right? And that sits over on sustainability. So every company that's trying to manage their opportunity is going to have to manage their water opportunity as well. So we look at it and say, from a sustainability point of view, that's really interesting. But you can go out, to something that doesn't seem all about sustainability, but really is. So automation is a good example. We've been investing in automation for more than a decade now. And the idea is that better process leads to better efficiency, right? Leads to better sustainability. And efficiency to us is a major growth factor that people don't pay enough attention to. And you can build efficiency well. So, we look at, individual automation companies in different manufacturing processes to say, okay, what are these automated companies? How many of these companies can sew a thread through multiple industries and create automation factors that improve efficiencies and improve output.
Yeah.
It's a simple-minded thing. It sounds like I'm talking, it sounds like I'm talking in 1889, about industrialization, but it is industrialization, but it's cleaner industrialization, and it's purposeful industrialization, and that is an enormous opportunity. Robotics sits in that,
Absolutely.
right?
Yeah.
It's a really cool. So that's how we think. It's where are the big cogs, and where's the value, right?
Yeah.
Forward.
Yeah. And it comes back to that sort of big long-term perspective. This is where I always think just a big whole system sustainability perspective combined with someone who can dive into the details of, companies and who's going to thrive, just it gives you such an advantage because we know where some of these limitations are, whether it's around energy or water or, demographic considerations. And you take that long-term view and you can then feed that in and see what companies, and it's incredible to hear about some of these examples that you've, either gotten into or out of early as a result.
It's exciting. I mean, I got to tell you, for young people interested in finance, I am telling you, it is amazing to see the world through these company income statements and balance sheets, and to see innovators on the ground trying to get something done. And there are many of these innovators out there that aren't in the thrall of Wall Street, that aren't looking for, the quick buck IPO, whatever it may be.
Mm-hmm.
There are people doing great work, right? Changing the nature of our economy on the ground all the time. And for me to have vantage on that and to be able to look and see what amazing things are being done on the ground. There are terrible things being done on the ground too, don't get me wrong. Mm-hmm. But I'm focused on the amazing things being done and supporting those and moving capital toward those. And it's really exciting. So for young people, I always feel that, I don't want them to be what I was when I went to I was like, this is like a toxic mess. Mm-hmm. And if I were young and looking at all this hype and all this craziness that's going on Wall Street, and stuff that's not really economic, and I would there's a side of me that would be like, I'm not touching that with a 10-foot pole. Mm-hmm. And I just want to say that is not what the real picture is. Wall Street is just a cover story. What's underneath it and the reality on the ground can be inspiring. And so you gotta get in there. You gotta, my partner talked about this recently, and Ted Lasso just made this famous, but Walt Whitman talks about the idea of be curious, not judgmental.
Mm-hmm.
We're living in a world that is extremely judgmental right now on every turn. And it's blocking out the curiosity that really will open the doors to opportunity. So I just would encourage young folks listening, stay curious and go after it.
Yeah, that's awesome. Yeah, we have, my wife made this really cool wall with a dartboard that just says "Be curious" in big letters, based on the Ted Lasso scene.
I cry every time I see that scene with the dartboard.
It's very cool.
I can't help it.
Yeah.
So I love it.
Nice. Well, tell us a little bit about just sort of like how you all are structured. You have public market and private market strategies.
Yeah, so we invest individual portfolios for clients, individual stocks, individual bonds. So we're asset buyers, right? So we're not saying like, oh, we're going to give you exposure with this ETF and that. We're buying companies and assets for clients, but we complement that for some of our larger clients. They want us to be doing these designs. They want us to be looking out and doing design. So we tend to go out in the world and, with solar, a lot of the opportunities are really on the private side. It's, in the public side, buying solar panels, I'll just tell you, not a great investment. Not a great, and we don't buy hyper cyclical investments or these types of things. We don't say, oh, but it's solar panels and that's sustainable, so we're going to own it. Right. Some people do that. Some people do that. They just put anything that sounds, and that's supposed to be an investment. So with solar, private is really where you can make the investment. And so we went, we were working, we do these innovation shops with different people. We were looking at young companies doing solar work, and one company came out and they had a really nice model for figuring out how to create solar justice in, inner city settings and settings where people had never really had access to these types of energy programs. And so they'd have like a corporate, solar piece, and they'd combine it with a church and a school in their city. And it was a really cool model, but they also de-risked it really well. So for me, with my clients, my job is to say, how do I make sure your capital, right, is the primary concern? Because if you mess up on an impact investment, if the mess up is that you only got people their money back, you can recycle that capital. And I really believe in the idea of whenever people have impact money, I want them to grow how much they have in impact money, and I want them to keep recycling it and keep making a difference again and again and again. People that invested in my first IMAX film, I had 2 that invested in 3 other IMAX films. So the same money they put into the first had impact all the way through. So we tend to want clients to feel that way. So this solar deal was very much built on the idea that they took all the development risk on the front end. They took the long-term risk on the back end of power purchase agreements, and we were financing a very financeable piece of the equation, but we did it at a lower cost of capital than they were expecting. Because everyone is out there saying, hey, we're venture investors and you need to give us this because we've got to get a higher return for. We wanted to provide a reasonable cost of capital that our clients would be happy with, that would allow them to build the model and show the success of the model. And so we've done that with solar. We've done that with, BIPOC-owned businesses in secondary cities. We did it for foreclosure prevention. And so for our clients, they really like to see these models. And sometimes we'll work with other people that are doing impact that do a better job than we would do in certain areas. So we have clients that have a section of their portfolios that they really want in this area. So that's sort of an unusual thing that we add.
A little more customized.
Market business.
Yeah. But you'll do both direct in private and help your clients find great funds that are working in private markets.
So sometimes we'll work with, there might be, for instance, there might be a fund that does a really, really good job in private lending to, mid-size companies that are in the middle of sustainability growth. So it might be, hybrid powertrains and, whatever. And they're really, really good at it. And we sort of say, wow, we're impressed with the managers and this and that. So we do that more rarely, but we do that as well.
Yeah, gotcha. We'll talk a little bit more on the public side about the shareholder engagement and sort of the active ownership component. And I was curious when you were talking about the water piece, for example, if you see a great company that has a great thesis or a great business model, but isn't kind of maybe aware of their water risk as much as they should be, is that the type of thing that you would engage on, or just talk a little bit about how you work with companies?
Yeah, engagement is such a good word because we're partners with these companies. We're trying to compound our returns with these companies. We're going to be with them for a decade, So a lot of what goes on Wall Street is the gotcha. Trying to find that one-off stat that shows that this company isn't perfect, and they didn't. Look, let me tell you, no company is perfect.
Yeah, spoiler alert.
Do better at what they do. Every company is trying to figure out how to get the job done right and to do it. And everyone wants to help with fossil fuel. But a lot of people still drive cars that have gasoline in it because maybe you can't get 400 miles, and anything else,
Yeah, we're living in a system that's all set up for these types of things. So
you got to be, that aha thing, to win points, and then to sort of try to take down. We have some of that in us, but not too much. We want to partner with these companies and figure out how, if they're having trouble, if we look and see that they're not doing great with water, we literally show examples from other companies that we work with to say, well, this is an amazing thing they're doing with water. What are you doing? And so we try to cross-pollinate kind of good management from different companies, talk through it with them. We do play a role in the I'm not sure that shareholder activism, because of the way it's set up, is actually the tool that really forces companies to change the way they work. Sometimes it's true if you get a very particular thing, but you have Vanguard and all these big places, it's really difficult to move that needle.
Yep.
So it's really about creating the conversations and creating the purposeful dialogue, right? Where you're saying, how do we fix these things? And so, with us, when we're with our companies, sometimes, we no longer have Tesla as an example in our model because of the governance concerns. But we had Tesla in our model for a long time, even with some of the Musk concerns. But we would manage to say that this made a lot of sense to us, and we had to have big conversations with our clients.
Yeah.
And we had lots of conversations with Tesla. We ended up having multiple direct conversations with Tesla again and again and again, talking about these governance issues and how they're going to change. And when we figured out that they weren't going to change, we ended up taking it out of our model because we felt that there was real risk on this side. So, activism can be powerful in that way, but what we're looking at it as is, how are we relating to our companies? We've done really good work with a bunch of our companies on a bunch of different factors. And this year we're really focused on pay practices. We're focused on politics, money in politics, and how that's impacting the world. And so we'll partner with other people on those, and also supply chain. We've wanted to focus on this for a little while, but a lot of what's going on in supply chain is exactly as you just said. The world is set up in a certain way. And, if you want biodiversity in our oceans, the world can't be set up in the way it's set up right now, because
Right.
you're going to lose.
That's
And
big
so-
system change. Yeah.
Yeah. So we look at it and say, okay, so we also do some big systems change type plays, or some larger plays, in addition to how we're conversing with our
Yeah.
individual companies.
That's great. For people who aren't as familiar, we talk a bit about, proxy voting and filing shareholder resolutions. But like when you talk about just talking to the companies, how does that work? Like, what's sort of the access like? Who are you talking to? I imagine it depends on the size of the company and how long you've owned them, maybe, or what is that kind of?
Yeah, I mean, sometimes, we like to think that we can break through every investor. You go to the investment group and they tell you what the talking points are for the company, and you try to break through that as best you can. It's harder at giant firms. At smaller firms, sometimes we're talking to the CFO and the CEO. Sometimes we're talking to, then they come visit our offices and stuff, because CEOs, we have enough capital, I guess, that a CEO of a mid-sized company that has us being like, we really like what you do. They like talking to us. And so that's fun. But for the most part, we kind of wend our way in. It's a little bit like building, you have a relationship. It's one thing if you're just coming in hot and calling a company. But if you've owned the company for 4 years and you've been calling them a few times a year every time, and you're engaged with, their shareholder team, well, then you start to get invited into some other things. And since we do our research, right, we have a different approach. Like, we're looking and saying, hey, it was the agricultural segment that you made all these investments in, and we were supposed to be seeing growth in, and we don't see growth. What's happening? And so when you're sitting on top of research, your questions are a little different too.
Yeah.
They're a little more in the zone where the shareholder person doesn't always have the answer.
Right.
Or if they give you a broad answer and you say that's not satisfactory, they have to get you to somebody.
Yeah. And will they do that? They say like, oh, this is not my standard kind of engagement.
By they, the answer is yes.
Sometimes.
Until you reach, I don't know, until you reach 200 billion. Until you reach a certain market cap, and then they then they just send you. I'm sure what'll happen in the future is they'll just send me some AI
right
like answer to my question that they assume is right.
Yeah.
So the process is a tough process. It's not easy.
Yeah.
I don't believe, I believe that the research tells the truth. If somebody, if I'm looking in and somebody said they were going to put money into R&D here, and they said it was going to deliver 12% growth, and it's 4% growth, then that money they put there wasn't making sense in R&D. And if I see, output measurements on water, and the goal was to do X, Y, and Z, and I see a different goal, and then I'm calling in and they're telling me that I'm not seeing what I'm seeing, then they're not going to be on our focus.
There's a red flag. Yeah, exactly. That's cool. I think it's great, like you were saying too, just about how exciting this all can be, to just kind of really show how you can engage with these companies and understand what they're doing and help them do it and help them do it better. And
Well, sometimes they think we're coming out of left field. Sometimes they're like, "Don't you understand? You know, we're trying to grow our earnings. We're trying to da da da." And we're like, "Yeah, but we just want to be with you for a long time." And we,
Yeah.
you know,
Again, let's start
we're
that.
with you. We're rooting for you, and we're just trying to show you some things that could be helpful.
Yeah, that's awesome. Let's talk a little bit about the state of the field. And we talked about the ESG, kind of some of the problems and issues with that and the terminology, but obviously this has all been so politicized in the last couple, 3-4 years. How has that impacted your work at all? Has it impacted how you talk about it, think about it, or not?
Well, it's brought us out. You know, I mean, we work. You know, we're a quiet place that loves what we do. We've got great clients. But when I saw what happened, and I see the sort of conclusions that people quickly go to, oh, that ESG was just a bogus. The same thing happened after socially responsible investing, which was just negative screening, and everyone's like, well, that's not investing, and they were right. It wasn't investing, and you know, ESG, that wasn't investing. And they're right. But the truth is that, you know, fundamentally, you know, I believe that good investing is sustainable investing, and that in a high, as we get more of this change happening faster, that change is going to force us all to look at the foundational elements of the companies we invest in and how secure those elements are and how directed management is at managing change. And managements are going to get better at managing change. Managements are going to get better at understanding risks. And I think that feeds into, right, smarter businesses are going to focus on sustainability. So we just believe it's the best place to be. So when the market goes off like this, and loses sight of a lot of these things, I see it as an opportunity. I basically say, well, hey, you know, they're missing out, and I'm going to be able to buy some of these assets that other people were just were leasing for a while. I'll get these assets at a good price. And so I think the market is the market, the street is the street. But what we've decided is we're going to take our wealth management. You know, we've done bits of work. You know, we started our own mutual fund, but it was really for our smaller clients because we felt bad that they couldn't have our whole portfolio when they didn't have as much money, or somebody's niece or nephew wanted to be involved and wanted to be part of this one. So we did it for access for our clients.
Mm-hmm.
Well, now it's gotten big enough and it's been out for 5 years. We're going to start sharing that in other places and having people see it. We're going to start doing more work with endowments and foundations to show that this is what discipline should be. And this is what people should have been talking about when they were talking about sustainability. And so, you know, for us, it's easy to do because we've been doing it for 20 years. We're built and set. We have this great wealth management business that we love, but we also have a tremendous opportunity to take our discipline and to allow other people to share that and move and show the right way of doing things. So we're on that kind of hunt right now, and it's fun. We're just starting down the path, but it's we really enjoy it.
Yeah. Well, talk a little. You said you're sort of a quiet place, and you know, been around 20 years doing this work. But sort of from the marketing perspective, it seems like you didn't sort of lean in or sort of shout from the rooftops the sustainability element for a long time. It seems like maybe a little contrarian now that everybody's running away from it. You are starting to talk about it a little more. So just, yeah, how do you think about that from kind of
the marketing? We are. I guess Patrick and I didn't feel we were growing fast enough, and we had enough business coming over the transom, and we're still growing, but now we're much bigger. Mm-hmm. At that time, we were kind of head down doing what we were doing and loving what we were doing, kind of building the whole thing out. And what we built out was incredible talent underneath us. What's crazy now is that, like, Patrick and I used to be, you know, like, well, all the good ideas come from us, and with it, some of our best ideas are more people below us now that are just really great researchers and just really smart. And so we have a bench and a team now. And before it was going to be like, you know, before we could have pushed out a little bit, but we didn't feel the need to, we didn't feel the want to. But this whole ESG thing really blew it and got us back to these sort of oversimplified conclusions, or these false choices, as you say very well, George. You say, like, you know, it's not a false choice between being sustainable and performing. Mm-hmm. I mean, that's not the choice. sustainability is a place where you might perform with less downside risk. And that's what we like. So all those false choices sit out there. The idea that ESG was broken or could never work was the thing that got us crazy. And then, so here we are, we're in position now to say, well, it's actually an exciting opportunity for us. Our wealth management is managed extremely well. We've got a large team that helps us manage everything now. And for darn sure, particularly for the younger generation, I've got to say, I am so inspired by the young people in my office and the young people that we're bringing in and talking to for their creative energy, for their ability to see disruption and look to the other side of it and want to see what's on the other side. Very Clayton Christensen stuff going on in this younger generation. They're seeing, right? They're seeing creative destruction in front of them, right?
Yeah.
They're seeing it.
Mm-hmm.
And they're trying to imagine what's on the other side of it. It's very intimidating. It's very hard. But if you're passionate about something and directing capital is a way you can really make change, I don't want that generation to have the lesson of ESG be what rings in their head.
Mm-hmm.
I want them to see the opportunity. And if we can get a generation of people thinking about finance the way that Patrick and I think about finance and direct capital in what I would say is more effective, right, and more sustainable ways, the impact could be huge. So for us, that's what we're on. That's the hunt we're on, I guess.
Yeah, it's so exciting. It can be empowering. And it's, in a lot of ways I see it's about building, right? It's about building that future and working with these companies that are doing it and providing them with the capital and the insights and being along for the ride. That's great to hear. So what are you finding from these young people that are coming into the firm? Are they coming to you? Are they seeking you out? Or do you have places where you go and find people that are particularly excited and talented for these topics?
Yeah, I got to say, it's hard. We do our process. When we do our process, it's such a different world today. I mean, you go and you get 800 resumes, you're just, blown away. And I think for a lot of the younger generation, I just feel like they've been matriculated into oblivion. Their whole life is like applying to things, and then everything talk about scale, then everything gets kind of automated, then everybody's doing, 50 resumes for different jobs, et cetera. And it's basically just about cracking in the door, and they don't even get down to what do I want to do or what would be interesting. We have young people that, in all of our networks that we work with, people see the work that we do, and it's pretty exciting, and so we get a lot of young people that want to come our way, which we appreciate, and I think we do sit in a particular spot where young people like to be dynamic. Now, to work for us, you have to have multiple dimensions, right? You have to be able to talk about stocks and understand what that's all about. You also have to be able to understand what's going on with sustainability and where it's valuable and where it's not, what's material in different industries, right? You also have to be sensitive to, social issues in companies. You have to be sensitive to social issues with clients. You have to be sensitive. And so it takes a lot to kind of put all that together. And so we're looking for and again, when I talk to people in college, what I say is, your job is to learn how to be a great problem solver. That's your job. And the world is going to change faster than you imagine. And your advantage is that you can be a problem solver in times of change when you need to be adaptable and you need to solve problems. That is going to be, a high value thing for the rest of your life. And so in a firm like mine, you have to be able to solve multiple problems. I don't want a researcher that only does utilities, right? I want a generalist that can talk against other generalists, that understands why this business is good in comparison to this business. And I want people that can communicate that out. So it's a hard job, but what we tend to do is hire people younger, make them do all the hard work of understanding what it is. When I first ran that nonprofit, I changed the ink in the copier. I did the paper. I did everything. I swept the kitchen every night. I had every job, and I learned how the whole thing worked, soup to nuts, right? and I was the executive director. So
Right.
I want people to feel that. I want people to come into a place and sort of bathe in all the silly transactions, whether it's a gift at year end or whether it's whatever it is for a client, and at the same time be steeped in a lot of this research, et cetera. And they'll learn it. It's one thing to learn it academically. It's another thing to be able to learn it and defend what you're saying and be able to be in a conversation with experts and stand up. And so I guess that's the way we get them in earlier, and sort of they're in a crucible. And what we found, I would think in that design, what we'd find is people would be like, okay, I thought this was going to be fun.
I was going to ask, do you have many people bail, or most people stick it out?
That's what's so crazy is our turnover is so low, because I think people see the opportunity, because we also have generational. This Patrick and I up here, we've just done an internal succession. So no private equity coming in, internal succession, where we've got new owners now that been with us for an average of, I think it's 14 years or something like that. So everyone knows them. They've been around for a long time, but it takes some of the pressure off of me and Patrick, but it also creates more connective tissue for the younger people to be able to talk. It's not this gapping to try to get
right.
And then we have a generation underneath them that are tremendous portfolio managers, and all these people, all the younger people underneath see those opportunities.
Yeah.
Say, I want to figure out how to be a part of that. So so far I'm knocking on wood, but it's been great.
Yeah, that's great. Well, I think the purpose component of it too is going to be compelling, that people want to stick with it when they see.
Excited about that when we're doing our impact research or doing, they want to dive into that, because this generation is purposeful. I think this generation, they're coming out like when I came out of the of college. I was born in the I lived in the 70s with the Watts riots and the terrible dislocation, and we were told that our generation wasn't going to have the same opportunities as our parents' generation had, and it was very similar vibe. Of course, then the personal computer showed up and things changed, and maybe AI is going to show up again. But in that time, that crucible, I gained a lot of purpose. I basically was like, well, this isn't how it should be. And I think there are ways it should be. And I think this generation is loaded with that spirit, and I like it.
Nice. I hope so. Well, Chad, this has been great. I can't believe how much the time has flown by, and I
just go off.
No, there's so much more I want to talk to you about. So hopefully we can get you back on. But do you want to wrap up? And I like to wrap up with just a few kind of fun, quick takes. So let's see here. What's the most common objection you hear about sustainable investing, and what's your response?
That you have to sacrifice returns in order to invest sustainably. And my response is, that's not my experience.
Right. We got the numbers to prove it. What's a company or a sector that you're most excited about right now?
Gosh, I really think the industrial sector is going to go through a reimagination in here, where the machines are going to be building the machines. And I think that's sort of a tertiary thing that people are looking at, but I do think that's one of the big cogs. That's one of the big cogs over the last 20 years has been innovation in manufacturing through efficiency, and I think we're about to have another phase change, and I don't think people are expecting it. So I think that's what makes it exciting to me.
Well, yeah. All right. How about a lesson that you took away from your documentary film world that applies to investing?
I learned a lot of lessons during that. It was a long go in a lot of ways. I think what it is endurance matters, and that purpose matters. And that, I never really doubted that I was gonna, it was an impossible feat to get that film done. And I didn't have any resources, and I was just cobbling together and doing it. But the longer I went at it and the longer I did it, almost the more inspired I got. And I think that lesson, that if you see it through, right. Not everything's going to work for you, but if you see it through to your greatest effort, and your purpose leads the way, and you're really problem solving to get real purpose done, I think you can go much further than you think you could imagine. It takes the quit out of you pretty quick.
I love it. All right. How about outside of work? What do you like to do?
So my family's a musical family. My wife and I met each other singing in college, and my kids all love singing. So we tend to go to shows. We'll sing a little bit in the car, and we tend to have music and art around us a lot. But also, as you know, I live up on north of Boston, and some of the most beautiful coastline around up here, and so I like wandering the coastlines as well. That's a pretty good pursuit of mine.
Yeah, we're pretty lucky up here. It's beautiful. Although I don't know if you've been out today. We got this polar vortex. It is freezing out there. Just walking the dogs this morning, and this is a tough one. All right, how about a book, podcast, newsletter, or some other resource that you think our listeners should check out?
Well, I've got a couple for you. I've got one right here. This is a friend of mine who just wrote this, and I just read it, and it's incredible. So it's called AI and the Octopus Organizations, right? And so Stephen Brill, who people may know, and then Stephen Wunker, who's a good friend of mine, tremendous thought leader. But basically the idea behind it is that a meteor hits the planet, right? In the Yucatan years ago, and basically sets the stage for mass extinction. Toxic, the sun's blotted out by toxic gases, and it happened in a moment, right? And there, a lot of the animals that survived were these they had shells, and slowly they came out of the shells after the toxic ooze and all that stuff. But the octopus survived as well because it is a master of adaptability and has the ability, whether it's changing color or whether it's fitting through a quarter hole through a master of adaptability with, each of its arms having different capabilities and its own focus. And the point is that as we get into that, adaptability and speed of change are going to become only more important for organizations at a time of high-speed change and the ability to execute through something like AI. And the organizations that are waiting on that or aren't taking the front end of understanding what their adaptability is and what it needs to be and how they as an organization can move in these current environments. I like to think that we're a very nimble organization because we have the size, we're at a reasonable size, and we're very clear-minded about where we're going. I think people should read this book because it's really, really important to have adaptability in not just in your company, but as a professional to understand that you're going to need to be able to fit into a lot of different places and pieces, and the idea of having a lot of knowledge and a lot of ability to adapt and adjust. We've all lived through it with all these software changes we've had, all this, we don't realize it, but we've lived through a whole lot of adaptation, particularly in the last 10 years, and it's accelerating. So that's one. And then I'll give one more, which is this movie that I saw on a plane that Patrick absolutely adores, but it was called Beyond Zero. And it was about this company Interface, which was a carpet tile making company. And the head of the Interface realized, after having spoken to people in sustainability, Hawkins' book, he realized that he needed to make these tiles so that there was no excess, pollution, no excess. And it's the story of him at this time when nobody was talking about sustainability, his passion for it, and his true love for getting this done right. And then it's a story that actually succeeds. And so I'm like crying on this airplane looking at this movie about about carpet tiling, and my wife is like, "What is wrong with you?" The CEO is amazing. So I recommend Beyond Zero is the second recommendation. So I've got AI and the Octopus Organization and Beyond Zero. Those are my
awesome. I love it. Well, I haven't seen Beyond Zero, but we did a lot of work around Ray Anderson's work in our graduate program and the networks we're in. And I actually just had his grandson now runs his foundation and was on the show a few months ago. Yeah. So I'll send you that episode, but I should check it out because it is a great story. And the foundation is continuing to kind of,
well, Ray Anderson was if anybody wants to be a CEO, look at Ray Anderson's work and what he does and the passion and that's what it's about. That's what it's about.
Yeah, absolutely. All right. Our final two questions we ask everybody. What's your vision for the future of finance?
More sustainable investing and long-term view. And that's where the success is going to be. As Patrick says, success, growth is going through sustainability. So if you want to grow your portfolio, you better go that way.
Awesome. And then you shared some of this, but any other sort of advice you give to students and young people interested in this space?
Well, stay curious is the first one. Don't go in there looking for a title. Don't go in there looking for a looking for your next job.
Fast track.
Job.
Yeah.
Find something you can be passionate about and dig deep and work hard. And I tell you that if you follow those rules early and give yourself time to accrue some capabilities, you have time, right? The career's a long time. Explore, learn, make mistakes when you first get out of college, take on challenges, but learn, keep learning, right? That's what it's all about. So I think curiosity matters, and the idea of not trying to find your next opportunity before you've gotten everything out of your current opportunity. That seems to be a problem today, is everyone's getting accelerated. It's just about how fast you move forward instead of what you're learning. And let's focus on what's important, and that's what you're learning.
Mm-hmm. Perfect. Chat. Well, that's fantastic. Thank you again so much for joining us and sharing your work. It's been a pleasure.
George, I love it. So much fun. I could talk all day. We'll do it again, I hope.
Absolutely. This episode has been brought to you by Metis Global Partners.
Thanks for tuning in for the Future of Finance podcast. We hope you found today's conversation insightful and inspiring. Don't forget to subscribe or follow us on your favorite podcast platform. And please take a moment to rate, review, or share the show. All of this really helps us to reach more people like you who care about creating a thriving and sustainable future. And it's a really easy way to have a big impact. So please do follow. A quick disclaimer, the content of this podcast is for informational purposes only and does not constitute investment advice. Investments and strategies discussed may not be suitable for all listeners. Please consult a financial, legal, tax, or accounting professional before making any investment decisions. References to managers and funds are for informational purposes only and should not be considered endorsements or investment solicitations. This podcast does not monitor fund performance or guarantee the accuracy of third-party materials or statements. This has been an episode of the Future of Finance podcast, exploring how finance can shape a vibrant and sustainable future. Thanks for listening, and we'll see you next time.